All right, in this lesson, we're going to be talking about shrinkage. Now, this is actually a two-part lesson. In this lesson, we are going to show you the conceptual framework and give you an understanding of shrinkage. In the next lesson, we're actually going to walk through an example of how we actually calculate shrinkage. So this lesson is all about just giving you a fundamental understanding of how shrinkage works and what it actually is. And speaking of what it is, let's talk a little bit about what shrinkage is. So shrinkage relates to the cost of any inventory that has been stolen, that has been an error, that has been fraudulent taken or a fraud number, or has been lost. Another way of thinking about shrinkage is shrinkage represents any inventory cost that can't be accounted for either ending inventory or cost of goods sold. So it's a super important number because this is basically saying that this inventory wasn't sold or we don't have it in possession, and therefore we're going to have to write it off as a loss. And you know, and I know, a loss is not good, especially if the product was, let's say, stolen. That means there was money left on the table, and you also have to pay for that stolen item because it's now gone, and you have to pay the vendor for that stolen item. Okay, so let's talk a little bit more about this shrinkage. So for companies, shrinkage is very important for running their business, as well as keeping costs of their inventory costs. So being in control of that inventory cost. Why? Because really for every dollar that inventory is worth, that's basically reducing their bottom line profit by that same amount, because that was the cost of that inventory item that wasn't recouped by revenues from selling that unit. So it's super important because we don't want this shrinkage to be too high. But we also know that shrinkage does happen in an organization. Someone drops something, someone steals something. It's just bound to happen. Our job as managers is to control that amount so it doesn't get too big. Now, companies want to know what the shrinkage number is so they can control it in the future. So if we know what shrinkage is, then management can do something about it to try to reduce that amount. Now, calculating shrinkage, well, shrinkage can only be calculated when we use the perpetual inventory system. So if you use the periodic inventory system, you cannot calculate shrinkage. There is no practical way of doing it other than you actually saw someone steal it and you didn't do anything about it, okay? Or you actually keep track of you damaging the inventory item and then throwing it away. Otherwise, there is really no way for periodic inventory system companies to be able to calculate shrinkage. You got to use perpetual inventory system. If you use the periodic system, by nature of the calculations, you just can't calculate shrinkage. It just can't. Trust me, it can't. Okay? So how do we calculate shrinkage? Well, here are the steps here. We've got two major steps here. Step number one is we're going to calculate how much inventory the company should have based on the following equation. So we will take the beginning balance plus the purchases equals goods available for sale. We should be keeping track of our cost of goods sold because perpetual inventory system does do that. So we'll subtract our cost of goods sold. That will give us our expected ending inventory. Then in step number two, we are going to compare the actual inventory. And when we mean actual, we mean we actually are counting our entire store of how much inventory we have now and comparing that to the expected inventory in step number one. And the difference will be shrinkage. Now, some people will think about this and go, what about if the expected is less than what we actually had? Then you have a negative shrinkage, okay? That means either you cost something out or maybe in a prior period you didn't count correctly and now it's catching up now. So that you could have a negative shrinkage, but I can tell you most often it's not going to be that way. You're going to expect to have $1 million of inventory, and then when you count everything, you're only going to have $960,000. That's usually how it happens. Now, if you're wondering how does this happen to every business will have some type of shrinkage. So unless you're really good like cars, selling cars, you probably won't have shrinkage, but Most retail stores will have some type of shrinkage in their business during the year. So how do we deal with it? Well, once we calculate shrinkage, we now need to write it off because that number is included in inventory. So our inventory is overstated. So what do we need to do? We need to bring down the inventory to what's actually in our store. So if we actually have $940,000 worth of inventory, but we said we'd have $1 million, our books show $1 million. We need to write it from $1 million down to 940, which means we're going to have to expense $60,000. So to do that, we actually have to do a journal entry to reflect it in our books. We'll debit cost of goods sold for the shrinkage amount, and then we'll credit our inventory account to reduce the inventory by the amount of inventory missing. Now, some people would say, why do cost of goods sold? Why debit cost of goods sold? Should you debit something else because you didn't really sell it? Well, we sometimes think of it from an accounting standpoint that we do it to cost of goods sold because it's just the cost of doing business. Unless you're willing to lock everything up in your business and keep really good control over that, it's just not practical. And so you're going to be okay with someone stealing something because that's going to cost you less than it would cost to implement an entire security system that nobody could actually access the products that they want to buy. So, you know, when we think about it, do we really want to lock up all the heads of lettuce in a grocery store and have an employee unlock it for someone and walk them to the cash register just to make sure that head of lettuce isn't stolen? Probably not. If one or two headed of lettuces get damaged or stolen, it's going to be way cheaper than implementing an internal control where we have everything locked up and then we have to have extra employees on duty to be able to unlock and walk that item to the front register. So shrinkage is just going to be better at the end of the day. So because it's just the cost of doing business, some would argue we would debit cost of goods sold. Sometimes if we want a little bit more detail, we'll debit shrinkage instead of cost of goods sold. So it really is up to, well, your assignment and what you want to do at the end of the day. But we're using cost of goods sold because it's just easier to understand that it really is the cost of doing business, the cost of the goods sold. So that's how we would do the book. So this entry will expense the cost of the lost goods and reduce inventory to its actual balance. So it would get our balance from $1 million down to $940,000, which it should be at the end of the period. So that is a look at shrinkage from an inventory standpoint. In the next lesson, we'll actually show you how we calculate it using the 2 steps that we talked about in this lesson. So I hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.